Well, I think the difference between, like, say, investing with me or investing with Starwood or Blackstone is, you can come into my office, sit down with me. I can discuss strategy with you. I know you. I know your family. I know your kids. I understand maybe some of the wealth transfer issues that you're going through. Some of these are family offices that have been growing over time, and we just have a long history, and so we can kind of understand where we fit within that dynamic. Versus, I think the larger groups are just trying to allocate capital however they can, and so they're like pushing their product through RIAs, which is fine. They're getting, there's been a lot of consolidation in the RIA space too, where, you know, they just kind of look at it as, oh, here, let me dump a bunch of money into Blackstone or the S-REIT or whatever large allocator you want to invest in. And where those guys are just, pushing out product and, kind of covering all their bases, where, we can kind of sit down with a unique strategy and say, hey, we're everything that Blackstone and Starwood is not. We're opposite their investment thesis, and we're trying to create alpha by not just blanketing the entire market and getting massive exposure, but to find unique opportunities within the space. And so for a lot of investors, they look at us not as, hey, I want to have a little exposure to real estate, but I'm looking for some returns.
Tom, welcome to the show.
Hey, Brendan, how are you? Thanks for having me.
Can you start by introducing Greenleaf and yourself to our guests who haven't had a chance to meet you?
Well, pretty exciting, actually. We're going to be known as GL Capital Partners. We're undergoing a kind of long-awaited rebrand. Greenleaf, we started back in 2008, right before the financial crisis. We were really focused on environmental, kind of rehab of older products. And, as things have kind of developed, we've kind of gotten away. I mean, still do that, but it's not our main focus. So we're just kind of trying to do a little bit, stronger tagline on the brand. So, but yeah, we started in 2008. Prior to that, I was in doing deal by deal syndications across the Southeast and Southwest. And in 2008, decided to form our first fund going through the GFC. And now we're on our fifth fund, vertically integrated. Pretty much have focused on investing Denver West throughout that time period. And we're vertically integrated on the fund side. We self-raise all our capital, and vertically integrated on the operations side, self-perform down at the asset level. So.
Well, I'm really excited for this conversation. I have the privilege of being able to talk to a lot of entrepreneurs like you who are what I consider to be, operators, specialists, sharpshooters, whatever name you want. And part of what I'm doing in this series that I'm hosting with you is to expose some of the kind of insights and lessons learned and kind of the business differentiation that you as a specialist sharpshooter have. So we're going to talk a lot about your firm today and kind of your thesis on the market and what you do. So with that being said, you mentioned that you got started in 2008. Why did you decide to start, what was then Greenleaf? Now, I think you said it's GL Partners. Is that right?
GL Capital Partners now.
GL,
yeah. Right. In 2008, I mean, we saw, obviously there was a lot of distress going on in the multifamily market and in single family. Prior to that, I was doing, deal by deal syndications. And I thought it was a unique, period of time in the marketplace where you just had foreclosures going on in single family. You're seeing just massive declines in value, and just saw an opportunity to kind of form a vertically integrated platform where I was getting a little frustrated with all of our third party managers, and, realized the whole model of me going out, finding a capital partner, then going to hire a third-party manager to execute my business plan. I was just, the GFC just kind of highlighted the weaknesses in that structure by having all these disparate deals that, didn't have the strength of a fund. And so I decided then that I wanted to self-perform and do it in a fund structure so that, the investors could be protected by the strength of multiple deals being owned, and also that I wasn't relying on third party manager to deal with some of the challenges that can come up when the market turns. And I mean that as we kind of hit the 2022 shift in interest rates, I mean, that's kind of borne a lot of fruit for us, that, we were in control of our deals, that we were in a fund structure. And that, if you have one or two deals that are going through some challenges, but you have the rest of your portfolio pretty solid, that you can kind of make choices that get you through that versus, if they're all just kind of one-offs, they got to, fight their own battles. So.
It's interesting because you chose to start with a fund, which I think many perceive to be a more challenging structure, just because you need to raise all the money at once up front to be able to invest. And a lot of people start deal by deal. You came from that world. What was your experience kind of getting Fund One going? And let's maybe talk about at the same time the composition of the investors that are in your funds. Are these institutions or individuals? How do you think about that?
Yeah, I mean, my first fund was probably the hardest thing I've ever did. I was raising like $4 to $6 million a deal, kind of from 2004 to 2007. We had bought like 1,500 units under a syndication model, and hit the GFC. Like I mentioned, realized the weakness in that, and I met some guys that I was doing some investing with on the courthouse steps, and they had some capitalization from some groups out of Canada that were investing heavily in California, single family at the time. And I convinced them to kind of give me, it was a $25 million fund, my first one. So it was kind of, the idea was I was buying $4 to $6 million deals, and we put 6 of them together. They gave me a $5 million kind of head start. And then I just kind of hit the road, and it took me a long time. It took me 2.5 years. So I started middle of 2008. I didn't finish raising that fund until 2011 to raise, $25 million. It was, I realized I wasn't the best at raising money. I needed to get a new partner at it, but, it was hard. It was a lot of individuals, and capital was so tight at the time. It was $50,000 to $100,000 checks. We had some kind of a rolling close where we did an A close and B close. And it was challenging. It was the toughest time I've ever had to raise capital. But once we did that, obviously investing a lot of that money was buying deals from banks. And so I think they appreciated the distress story. And then by 2012, that entire, fund had been lifted out of the bottom, and, did extremely well. So, and then from there, one of the guys that was an LP in my first fund joined as a partner, and he's been kind of in charge of capital raising since then. And he had a lot of experience raising money through venture capital and worked in some global banking relationships. And so he's really kind of spearheaded it. And most of our investors now are ultra high net worth. So, 5 million plus net worth.
And when you think about when you think about where you are in the business, so Fund One was definitely kind of school of hard knocks, and you probably learned every lesson in the book a few times. And today I think you mentioned you're on Fund Five in that series. What's the kind of size and scale of the capital, and how is the capitalization of each fund progressed? Kind of rough justice here.
Yeah, so we did 25 first fund, 150 fund 2, did about 275 fund 3, and then we've done 425, 450 for fund 4, fund 5.
That's impressive.
Yeah, so I think that's been kind of a size that we've been pretty comfortable with. I think we could stay boutique, stay sharpshooter, probably, especially now given just the cost of units has gone up since we started. So I think we could comfortably execute probably in that 500, 550 million range at our same kind of strategy that we've been doing. Back when we started, you were buying 200 units for, 260,000 a unit. So, I mean, that doesn't exist anymore. So, I mean, the cost of just real estate has gone up over time. So we're kind of buying the same amount of units per fund. It's just, the cost of the properties are a little higher.
In today, Fund Five in aggregate, what's your kind of unit under management or your scale from an assets perspective?
Yeah, well, so we fully cycled out of Fund 1, 2, and 3 prior to this shift in interest rates. So we had kind of maxed out about 7,000 units. I sold 85% of our portfolio prior to 2021. And so we went into kind of this shift only having, I think we had like 1,500 units or so. And then we bought in another 2,000 in the last 2 years. So been pretty active. So we're a little under 4,000 right now. We're closing a couple of deals this month. And so that should get us back to 4,000. I think our goal is to kind of maybe grow back up to the 7 to 10,000 range. Just kind of depending on market dynamics.
It's interesting because one of the big trends that I'm sure you see in the headlines is some of the more institutional players are trying to tap into the ultra high net worth and private wealth space. You started there and you've had success scaling through subsequent fund series. What do you think you can attribute that success to, or what have you learned about being a fiduciary for ultra high net worth investors who want exposure to real estate in a fund structure?
Well, I think the difference between, like, say, investing with me or investing with Starwood or Blackstone is, you could come into my office, sit down with me. I can discuss strategy with you. I know you. I know your family. I know your kids. I understand maybe some of the wealth transfer issues that you're going through. Some of these are family offices that have been growing over time, and we just have a long history, and so we can kind of understand where we fit within that dynamic. Versus, I think the larger groups are just trying to allocate capital however they can, and so they're like pushing their product through RIAs, which is fine. They're getting there's been a lot of consolidation in the RIA space too, where you know they just kind of look at it as, oh, here, let me dump a bunch of money into Blackstone or the S REIT or whatever large allocator you want to invest in, and where those guys are just pushing out product and kind of covering all their bases. Where we can kind of sit down with a unique strategy and say, hey, we're everything that Blackstone and Starwood is not. We're opposite their investment thesis, and we're trying to create alpha by not just blanketing the entire market and getting massive exposure, but to find unique opportunities within the space. And so for a lot of investors, they look at us not as, hey, I want to have a little exposure to real estate, but I'm looking for some returns.
When you think about this idea of finding alpha, and we've talked a lot about this on the podcast, whether real estate is designed to produce alpha or is a diversifier, when you talk to your investors, is it really that they're looking to you to produce alpha, or is it more of a diversifier, or a little bit of both? Kind of what are you hearing and seeing from your investor base?
I mean, I think we first of all, we want to be, good stewards of capital. So we're not taking, I would say, massive amounts of risk like a, value add syndicator that's, trying to generate 20% returns. I think they are looking at us as somewhat of a diversification to get into, real estate. As multifamily is just kind of an allocation, but they do like the idea that we're trying to, generate a little higher returns than maybe they can get from some of the other funds that are out there.
And what do you think, given your deep experience working with this audience, what do you think is like most misunderstood about working with ultra high net worth or family office individual investors? Because a lot of our listeners, I think, primarily have institutional capital. So your insights here would be really valuable.
I would say, probably is understanding their tax concerns. There is so much motivation for individuals, especially here in California, as it relates to their individual tax concerns. So, we have some unique structures in place that kind of enable us to, do some, kind of quasi evergreen structures where we can do a redemption renewal, where instead of selling everything, we're moving it into maybe another kind of fund series that is a refinanced, given if the market conditions are good. But I mean, they're driven a lot by their post-tax returns on an individual level, and having the structure in place to simplify that. So we're set up as a private REIT, so that if you're invested across 10 states, if you don't have that REIT blocker, you're having to file, each one of those LPs has to file taxes in every state. And that's, those kind of small things are an annoyance to them. They also like some sort of distributable yield. I think where some, most institutions, they're less concerned about that. I think individuals like distributions as part of their return.
And do you think that as far as the progression of the business, you'll move to institutional capital, or do you want to stay kind of private wealth forever?
I mean, given the fact that we've built this, private wealth network up over 17 years, I'm not planning on shutting that down anytime soon. I think we have some great momentum there. I would like to, add some institutional level of investment alongside of it, whether it's a parallel fund or, something like that, to just kind of one, create some a little bit of diversification in our capital base and, allow some potential co-investment opportunities and certain unique things that we see that maybe our capital base couldn't take advantage of.
And just give me a perspective from your capital based perspective in terms of like investor count, like roughly, what are we looking at from investors or investment positions?
Yeah, I mean, so on our $450 million fund, our average investor is about $2 million per ticket. So, we're 200 so investors per fund. So pretty large number of investors per fund.
Yeah, so a lot of people look at that, their heads will explode. When I talk to institutions, they often tell me, "Oh, I've got 12 investors per fund. Can you handle that? That's a lot." How do you think about scaling your business? This is always one of the big challenges when you're working with individual investors. How do you scale the operations? How do you scale the reporting? How do you scale the personalization when you're dealing with so many unique investors?
Well, I mean, you guys have been great help at kind of, you know, crazy enough, like on our first fund. I mean, we were doing everything through Excel and email, and that was like an absolute nightmare. We actually, I think in that fund, we raised 25 million and our average investor was like, 100,000. So we had 250 investors in this fund and we're doing everything Excel and email, and it just didn't work. So we realized that we had to kind of step up our game on the fund management and reporting side, and that's where you guys came in. So thank you for that. But it really allowed us to not to focus more on client service and individual kind of needs, and talking to our clients versus a lot of the reporting and distribution stuff like that we were able to automate. So I mean, it's not, it is a lot, but I think once you get it set up, your company's just used to it. So whether, I mean, if we had to go from 250 to 1,000, I think that would be an issue. But to kind of stay with our number, we're like 85, 90% same investors in each fund. So when you have that crossover, you get to know a lot of the families and the individuals, and becomes pretty kind of routine clockwork.
I don't think I've ever asked this question to a guest before, but I'm curious because it just came into my mind. If we were to sit down with one of your investors, they were joining us on this conversation, and ask them, about their relationship with your firm, what do you think they might say? How do you think they would describe it?
I mean, depending on, if you had talked to an investor that came into, one of our first funds and has been in all five, I mean, I think, they would say we've, you know, delivered a tremendous amount of wealth to their family. And we've been a trusted partner for them, through this. I mean, we always try to have a very open dialogue with our investors, and do what's right by them. Like, being a steward of their capital is kind of what drives our business. I having met a lot of the investors that we have, I mean, you just care individually about them and their money as if it's your own. So I think that's maybe a little bit of a difference when you're working with families and people, and you're talking to them, and that they work their butts off to get their money that they're investing with you. You just take it pretty seriously.
And when you think about, your business going forward, one of the things you mentioned before, you wanted to have funds because you wanted to have the diversification of, multiple deals in a structure, but you also wanted to be vertically integrated. What led you to the decision of going vertically integrated? Because I know that, the market is split. Some firms outsource that and some firms keep it in-house. And maybe even elaborate a little bit further on what is vertical integration for you. Do you do your own, kind of renovations and construction, or is it really kind of property and asset management? What does that look like?
Yeah, I mean, we do everything. I mean, I think there's certain times, like we've turned over student property in a certain market where we just kind of felt like, hey, we need a specific, unique specialist for this property. But for the most part, we wanted control of our vendor relationships. If we decided that we wanted to kind of push through an initiative through our properties. I didn't want to have to, go talk to our property managers, and maybe I have 5 or 6 property managers at different markets and try to consolidate some sort of initiative rollout that we thought was important. So we really wanted to be able to control the end user experience and to control the kind of how our employees are trained and how they think. And, we used to call it like the Greenleaf way is different from, at the time, Alliance, Greystar. We just did not want to be the same as every other operator out there and wanted to just do things our own unique way that we thought was a unique niche in the market. And I'm very proud. Like we have so many managers that have, kind of been on board with us for like 15 plus years, and done multiple projects with us, and just kind of find, our style, a little bit more family orientated from a small business standpoint versus just being a kind of another number. I mean, the biggest challenge is, trying to find career opportunities and growth. And so we have like a unique bonus program for our managers where, if we buy a deal, they're part of our business plan. We give them, multiple 6-figure bonus when we sell. If we hit our business plan, which is unique in the industry. So it's basically like, hey, you're in charge of a $60 million asset that we're going to run for the next 5 years. And if we hit our bogey, you're going to get a couple $100,000 bonus. So, and that's kind of enabled us to really get our managers to kind of buy into the business plan versus just, processing paperwork, looking to become a regional, whatever the normal property management growth pattern is. And that's been the challenge. I mean, with so many properties coming down the market the last couple of years, I think that's not talked about as much. It's just how hard talent is to find in the property management business. There's all these new jobs that got created, all this new supply, and finding really good people is tough.
Yeah, I think incentives and alignment are critical. Have you found that that's impacted your retention of employees or helped accelerate recruitment? Kind of what are the impacts?
Yeah, I mean, mostly it's accelerated retention. I mean, it's just, people, sticking around, understanding, hey, let's work together for a common goal. And like I said, having managers that have been through multiple, kind of deal cycles with us, you just kind of develop a level of trust where you're just kind of putting in a team that, can move in and, execute on something. Once you sell one asset, they're ready to go. It's kind of over to a new project. As far as, I would say that is probably a little bit of a challenge for us, when we're going out for a new project, getting people to understand, hey, we're a smaller company, they might not see like the upward mobility. So, we do have to kind of coach, people a little bit and get them to understand, what it means to kind of join, Greenleaf versus joining like Greystar. So, but, we still definitely get people from those companies to join us. So.
When you look from the outside in at multifamily, there's been a lot of capital that's flown into the space over the last, cycle or two, call it, 15 years since you started the business. One of the knocks that I hear is that, the world doesn't need another multifamily investment manager. There's so many of them. Yet I think we all know that while there might be a lot in terms of count, differentiation matters a lot. How do you think about the way that GL Capital Partners differentiates itself in the market? Like what's you've talked a little bit about the managers, and I think that's a great example of how you recruit and retain great talent. But what else is kind of unique about the way that you conduct your business and run your run the company?
Well, I think, has been so much, so many investors that got into the space in this last cycle coming out. You had people that were, doing different product types. You see a lot of single family operators started getting into multifamily. And I mean, it kind of reminded me of, when we were going back in 2004, 2005, like everyone all of a sudden was a real estate developer out of nowhere because there was so much money out there and people were able to just kind of jump into the business. If there's money being thrown around, people are going to take it and they're going to, go try to make things happen. And I think the same thing happened in this cycle. So, I mean, being through, a couple cycles, now you can see like, hey, over 20 years of experience, founded the company, myself, and being cycle tested and having the same kind of vision structure and doing the same thing for that long, I don't think there's as many investment managers out there that can actually say that. So I think there's a lot of people that say, oh, I've been doing this for the last 8 years where it was easy. And then you ran into some hiccups. So, I mean, I think if you measured our fund performance or vintage performance from inception to date, you would just, find that we're unique in being able to navigate through kind of these, different cycles and markets.
And one of the trends that I'm seeing is that, private equity investment managers in real estate and elsewhere are realizing that their businesses are really valuable, and or, you need more GP capital to scale. And so firms are starting to sell kind of ownership interest in their GP or stakes in their business. How do you think about kind of the ownership and the go forward plan, for the business at the opco or topco level?
Yeah, I mean, we've had conversations with people, and I think if it was the right strategic partnership, I think I wouldn't say no to that, but I just haven't found a capital alignment where they weren't just basically buying our future profits for some cash today, and I was going to have to work for them now versus working for myself. And so I as of this point, I think I like the nimbleness and flexibility that we have in our current structure. But if we found like a great capital partner that, aligned with us, that could help us kind of accomplish our goal of, having this, parallel institutional fund that, we don't want to compete at the top level of the market, but we also don't, necessarily want to get, beat from just a capital standpoint. So, and that's sometimes when you're using only high net worth, there is definitely a cap to the amount of money you can raise. It's so you miss out on certain deal opportunities.
Let's transition over to talk about the markets a little bit. So you're a multifamily specialist. Where do you see, we're recording this in January of 2025. As you look out over the next 12 to 36 months, where do you see the greatest opportunity in multifamily? What are you rotating into? What are you rotating out of from a thematic perspective?
Yeah, I mean, I think in 2022, as soon as interest rates spike and we saw this wave of supply that was coming, we really wanted to go in and say, hey, we're going to try to buy as much of this new product that's being developed as possible from potentially, people that need to sell, that, have loans coming due. It didn't really come to as much of a fruition as we thought. I think a lot of those deals got capitalized on the back end through different, pref equity structures and, other workouts. But we were able to, definitely, buy a few properties under that strategy. Where we're seeing the biggest opportunity right now is kind of on the opposite end of the spectrum, where you had a ton of value add capital that flooded into the market, from, post COVID 21 into early 22. I think 21 was a record amount of transactions. And a lot of that was funded by, short-term bridge debt which was floating rate. And there's just a real kind of gap in the capital right now where everyone wants to buy, new product, new suburban, maybe new urban. And no one's really kind of looking at, older workforce housing that, you might be able to pick up at a very cheap basis that, needs some capital put into it as some of these earlier repairs have gotten put out. And right now there's really a lot of capital in the market, but it's more institutional, private fund money. There's no syndication capital. So we think there's an interesting opportunity to buy into that hole where the syndicated capital is kind of out, and, hold and flip it once the syndicated capital kind of comes back.
And from a geography perspective, are you constraining, like, how is your ability to scale given you're vertically integrated? Does geography serve as a, constraint for you or an opportunity for you?
I mean, certain markets there's certain markets in the Midwest that I love. And we would probably have to hire a third party manager for like a year or so just to kind of get our, feet solid on the ground. It's pretty hard to, kind of ramp up when you don't really know the market. But for the markets that we operate in, I think it's an opportunity for us to continue to grow our unit count in those markets and to, build more strength through there. So, but new markets can be a challenge. I mean, I think there's been times where we've kind of paused because, we don't want to buy, 150 unit count deal that's on an island. It's just tougher to manage. So we kind of look at things from that perspective. So there is definitely some constraint geographic wise, but I think there's plenty of opportunity in the markets that we like. In Phoenix over the next couple of years, we think supply will kind of peak out in 2026, and you'll see a reversion of operating trends in that market that it's gotten hammered with 2 months concessions and reduce occupancy, but you still have a really solid demand side story. So that's a market that we've been kind of patient on, waiting to see where some of these trends might start bottoming, and we think that probably going to happen this year. Salt Lake City is another market, similar story, maybe a little behind Phoenix. We like Denver just super liquid market and good positive demand trends. So.
And do you worry about kind of the competition on the capital side? I mean, you mentioned there's been a bit of a clearing out as a result of the syndicators retrenching. I don't want to put words in your mouth, but it seems like that is what is creating the opportunity at this moment in time. Or are there other capital sources that are, coming in that you're finding you weren't competing with before, but now you are for new deals?
I mean, I haven't seen a ton of capital sources that I've never seen before. I mean, I think there's definitely is capital still in the market. I mean, you go, we bid on this property in Vegas that kind of checked, a lot of different boxes, and it was pretty competitive, like more competitive than I would have expected. And, same thing for a property we looked at in suburban Denver. I think it was kind of similar, in nature. There's some all cash buyers out there that are taking advantage of, their ability to not be beholden to, the current interest rate environment. But I think overall, that's why I said we're looking at just like different pockets of capital where, I think things that are right down the fairway in certain locations the capital is as aggressive as ever. I think people want to get money out. They think this is a time in the cycle where, operational trends have gotten hit, where even if you're buying, at a low cap rate right now, that you've really had like 3 years of, pretty muted rent growth across most markets. But at the same time, you've had incomes like kind of skyrocket. And so your affordability for renting right now is some of the better metrics that we've seen in a long time, especially when you compare it to, single family housing and buying a home. I think we were tracking that your average, check is like 22, 23% in a lot of the markets, that, your rent to income ratio, where, when the market's getting, pretty tight on rent growth going up, you're in that 30% range. So I think there's some positive trends coming for rent growth across most markets in the next 3 years.
Is that the leading indicator that you're focused on when you look at a new market and size up the opportunity, rent growth?
Yeah. We love just properties that we feel are affordable to the demographic. So if we go in and the average income is, 125, 130,000 at the property, and your whole dollar rent check is, 2,200. I mean, that's like, hey, the people here are living a good life. They can afford to live here. They're more likely to stay. They're not going to be stressed. I think, affordability in housing is, one of the biggest challenges that our residents face. And so finding properties that are affordable to the residents is a key metric that we look into. And and a lot of times it leads to organic rent growth through renewals.
As you think about, any changes in your business, is there anything that you're anticipating doing differently over the next, call it 12 to 18 months, as compared to, maybe the prior 12 to 18 months? Or is it really kind of business as usual and executing against the plans that you've laid out?
Yeah, I mean, I think the one biggest change is we would like to make a foray into the Midwest. We've been tracking it for, a couple markets out there for the last 4 or 5 years, and we've bid on a few properties. And so I think we definitely will get a flag planted in one of these markets in the next 12 to 18 months. We're probably cycling out of a lot of the urban stuff right now and maybe looking a little bit into, I think like some of those gaps I mentioned in the capital markets where it's workforce and fill housing. So
One of the, I think, misperceptions is that if you're not institutional, you're not sophisticated, or if you're not institutional, you don't have the operations or the governance. What would your, and I'm hoping that a lot of people listening to this are institutional. And part of this series is to help them understand the perspective of, the local operators, the sharpshooters, the specialists like yourself. What would you say, to those who say, if you don't have institutional money, you're not enough. You're not of our level. How do you think about that? And, as it relates to your business?
that's what drives me every day. I love having that chip on my shoulder that, I'm not enough, but I think we still, we want to be institutional for all the things that I think are of value to our investors, having, we get, audited every year. E&Y does our tax work. We've had the same auditor for the last 15 years. We have a lot of corporate compliance, as it relates to, deal and, cash flow management and all the other stuff. So from a standpoint in stewardship of capital, I think we would, if an institute, we're set up for an institution to come in and say, oh, wow, you guys have a lot of the, checks and balances and some of the processes that we have. I mean, a lot of our key, corporate employees have come out of, pretty large institutions. So we took a lot of what I think is the value from that business, but still try to keep it entrepreneurial. I think the institutions, they have so much capital that it is and we're in a capital intensive business. So they're always going to have the upper hand. If your cost of capital is cheaper and you're solving for a lower return, you're going to be able to execute a wider business plan than I can. So that's always going to be somewhat of a challenge. So we have to stay on our toes and try to stay ahead of them a little bit.
I love that. And I really appreciate the way that you answered that question. We didn't, for our listeners, we didn't prep for any of this as Tom, but like, it's honest. And I think it's really important to understand, the importance of governance, the importance of your fiduciary responsibility. And then the last thing that you said, know what your swim lane is, stick to it, be really good at it. And so, I appreciate that perspective. For our listeners who want to learn more about GL Capital Partners, who want to get in touch with you, who, whether it's, just to learn more about the business or explore opportunities, what's the best way for people to become more familiar or get in touch with you?
Yeah. I mean, glrecap.com is our website. If you go on there and, you can email me directly off the site. We could share my email address too, but I'd always love to have conversations. I'm also on LinkedIn, always connect with people on there. But one thing I've learned as an entrepreneur is, take every meeting that is of value. And so I love to talk about the market and learn and, happy to have these conversations with people.
Excellent, Tom. Well, I've appreciated the conversation today. I always enjoy our chats, and thanks for sharing more about GL Capital Partners and what you've been up to, what you're going to do going forward, and look forward to continuing to watch the journey and appreciate the partnership.
Thank you, Brandon. Appreciate the time.